So when we value a company, there's three approaches, and there's lots of methods under each one. There's the income approach, and that's a future forecasted cash flows. There's the market approach, where we're looking at comparable transactions. We look at the valuation from either one of those methods, and then we subtract out the valuation from the asset approach. And that's the valuation of really your asset approach of your assets less your liabilities. And we can adjust those to the fair market value. But the difference between evaluation from the income approach and subtracting out the asset approach, that value, that differential, that is the value of your intangibles. So your intangibles could be anything from your brand of your company to proprietary software, to the patents you hold, to customer list, to enterprise goodwill, or maybe personal goodwill of the owner. It could be encompassing of a lot of things, but that value is there because those intangibles are giving rise to the value to your revenues that you are currently making. Now, part two is for a company that maybe just patented something new, or they have a brand new piece of software that they're going to license out, or it's something brand new, or it's a brand new company and they haven't really gone to market yet. For those type of scenarios, we can do a custom valuation for that particular piece of intangible, whether it's a patent or a piece of software. And there's methods that we use to value them. And there's lots of different methods. And we can talk about that in another video, but that's how we handle really new things that haven't had time to really build or generate revenue from those particular items. Those would be a custom valuation.
When you look at technology companies, some of them experience inconsistent growth because perhaps they're sunsetting a technology, they may be entering new markets, they may be injecting capital from investors, a variety of different reasons for an increase in the cost, a variety of reasons for why they may experience inconsistent growth. So how do you account for a technology company that over the last 3 to 5 years has had just inconsistent growth and revenue streams?
We look for the story behind the inconsistency or the fluctuations. And depending on the story, it will inform what we do next. For example, during the period of COVID, a lot of companies experienced a decline. Some companies in certain industries experienced an increase. We want to understand the story behind the fluctuations, either in the revenue or the profitability. If it's a one-time item, we can either normalize for that item. We can really ignore that particular year, for example. If it's an item that gave fluctuation to the profitability because there was a one-time expense, we can adjust for that. We will also benchmark the company. That's really important to know, that we will understand if the fluctuations were really more of an industry-wide, something that happened in the industry. Because if the company is, let's say they went up for 3 years in a row, but in the next year they had a sharp decline, if we see that same pattern in the industry, we know something happened within the industry and we'll take action accordingly from that. However, if the industry is showing year in and year out steady state growth, but the company is very erratic, there's not a good explanation for that, then we will factor in those fluctuations in the valuation of the business, knowing that it's common for this particular business, for whatever reason there might be, that's going to be most likely going to continue to happen. And so we'll look at that, we will account for that in the base, and then for future growth, we will look at those fluctuations. We will also look at future industry growth, or we'll look at the long-term growth of the economy and assign what future growth looks like. But we will absolutely look at the past, and first and foremost, the first step is to understand what those fluctuations are.